Hello, everyone, and welcome to Schwab Coaching. My name is Cameron May. I'm a Senior Manager of Trading and Derivatives Education at Schwab, and this is Getting Started with Options. And today I want to talk about strike selection. When a trader has settled on a stock, and maybe they've even settled on a specific strategy, how do they choose which strike prices that they might use to set up that strategy? It's an important decision. It's not actually even a subtle one. Different strikes can carry very different trade scenarios. So we're going to get deeply into that today. It should be a really good discussion. Before we can get to any of that, though, let me first of all say hello to everybody that's already chatting in out there on YouTube. Good to see so many familiar names again. Hello there, Gary and Tatiana, Paul, Eva. Who else is here? We have Marcus. Hello there, Lawrence and Tony, Doug, Jay Richardson, MS. Everybody else, thanks for joining us week after week. We always do appreciate your attendance and your contributions to these discussions. If you're here for the very first time, I want to welcome you as well. And if you're watching on the YouTube archive after the fact, well, enjoy the presentation. Be aware that you're invited to join us in a live discussion. This is a Tuesday webcast series, and we kick things off promptly at noon Eastern every Tuesday. We'd love to have you here in the live stream audience. And I also want to let our live stream audience members know that we have Kevin Horner hanging out in the chats. Kevin's going to be helping me with any questions that I can't get to, just as long as they're not too far off topic. Kevin's there to help pick up my slack, so thanks for being there, Kevin. And Kevin and I would also like to issue an invitation to everybody watching. If you have an account with X, give us a follow. Follow your favorite presenters on X. It's another resource that you have out there to connect with those presenters. And you can find Kevin there at Kevin Horner CS. You can find me on X at Cameron May CS. But let's get into this discussion of strike selection. And of course, as we do, we need to first of all consider the risks associated with trading. These disclosures are important, so please bear them in mind. Options carry a high level of risk and are not suitable for all investors. The information here is for general informational purposes only and should not be considered an individualized recommendation or endorsement of any particular security, chart pattern, or investment strategy. Spread trading must be done in a margin account. Schwab does not recommend the use of technical analysis as a sole means of investment research, and investing involves risks, including the loss of principal. All right. So with that said, let's get into this discussion. So setting an agenda for today, I want to set up an example trade scenario. Today, we're going to be trading an example long call vertical spread, which we discussed in our series of 10 lessons. So if you need to go back and revisit that, you can. But we're going to set up a trade scenario as an example stock. And I've already pre-selected our strategy, but the question here is, which strike prices might the trader use to construct that vertical spread? So we're going to plan our trade. We're going to weigh the pros and the cons of different strike price selections, and we're actually going to place an example trade today. So let's go right to Thinkorswim. Yeah, Gary says, welcome to all the newcomers. Absolutely right. Great to have anybody here that might be new. Oh, Free to Choose Too says, greetings from a new attendee. Welcome. Great to have you here. But let's go right to Thinkorswim. And I just want to set up a quick technical outlook for, let's use Chevron as our example stock today. Chevron, over the last 12 months, has really struggled to get above and stay above about that 166 level. You can see one day before this last week where we poked up above that 166 and closed, but rapidly fell back below, and that's been a price ceiling ever since. Now, for some traders, what's happened over this last week might be technically significant. Let's say that our example trader here is noted. We finally popped up above 166. We've held up above 166 and actually haven't closed below that level now in 5 days. And this might be, to some chart users, an indication that CVX is set to go on another run upward. So we're going to plan a bullish trade. And how about we plan it somewhere out into the near future here? I'm going to recognize just over the horizon here is an earnings announcement. That looks like that's scheduled for May 2nd. So how about we plan a trade that will end before May 2nd. Now, there's nothing inherently wrong with trading over earnings. It does introduce volatility. Volatility can be good or it can be bad. But for today, let's just take that out of the equation. How about we plan for, I know that there are some weekly expirations for April 25th. So let's look at April 25th for today. All right, so The outlook for our stock, just to revisit, let's say our trader thinks the stock is likely to rise from here, or at least hold steady above that 166 level. So neutral to bullish. And that's a pretty good description of a long call vertical spread, depending on strike selection. So let's go start to build that vertical spread. Now, if you're not familiar with this strategy, let me give a quick suggestion to everybody watching. If you haven't subscribed to our Trader Talks channel on YouTube, please do that now. You can go down below the video stream and just click on that subscribe button. It literally only takes a second. It doesn't cost anything. But our channel is where we house our previous webcasts in these playlists organized by series. You can also join our live streams here. But once you've subscribed, just go to YouTube after today's discussion and look for our homepage. You can just do a search for Trader Talks Schwab Coaching Webcasts, and that'll find it here. And then you can just go to the playlists. And if I scroll down almost all the way to the bottom, it's going to be the second one from the bottom is this series. And it has Barb's face on it because Barb used to teach this webcast series. But we can just click on View Full Playlist right here for Getting Started with Options. And this is where we can find the series of 10 structured lessons that I put together for beginners for these sorts of strategies, including one called Building Combo Strategies, Long Call Spreads. That's the one that we're going to be leaning on a little bit today. All right, so let's go back here and we're going to build a long call spread. Now, as we do this, we have all sorts of different choices for which strike prices we might choose to trade. Now, notice here I have the 25th of April opened in our option chain, and we have CVX loaded. So we have to just make sure that we're on the right stock, and we're looking at the intended expiration. So this was the one that we were looking at right before that, that earnings announcement. And let's look at, we're going to have time. Let's look at comparing at least two different vertical spreads constructed using different strike prices. And the first one I want to do, we're going to structure a trade that will benefit as long as CVX is above, and maybe I'll draw in another line here. Where's April 25th? I'm going to draw in a line to represent April 25th. That'll be right here. So there's that expiration. That's just to give us that visual reference point. That's the expiration that we're shooting for. But as long as the stock is above our vertical spread, that's where we'll be in best position for our maximum theoretical gain. So what I'll do for this original trade, how about we look at maybe building a trade using the 165 strikes and the 162.5 strikes. So there's 165, there's 162. And here's what that might look like according to current numbers. So this is going to be our example. We'll call this example trade A. This is going to be our in the money spread. And for this, let's go to the 162.5 calls. And we're going to buy those. Those look like they're trading between 720 and 740. So we're going to buy the 25th of April, 62.5 calls for, let's say, 730. Prices are changing. These will fluctuate as we're talking. That's okay. Now, at the same time, to complete our vertical spread, let's sell the 165 calls. And those look like they're trading between 535 and 555. Let's call it 545. Sell the 25th of April, $65 calls for $5.45. So what a trader really needs to do when they're setting up a vertical spread, and we discussed this in detail in that lesson that I just showed you, that video that I just showed you, but the trader really needs to be able to break down the elements of the different contracts that they're getting themselves into. So let's look at this first one. What we're doing here is we're spending $7.30 per share, 730 bucks. And in exchange, we are purchasing the right through the 25th of April. We will have the right to buy shares of in this case, CVX for $62.50 per share. Awesome. If the stock goes shooting up, we've locked in that contractual purchase price of $62.50. It came with a fairly significant cost there, $7.30 per share. Well, on the other side of the coin here, we've pulled in, theoretically, a premium of $545, $5.45 per share. But in exchange, someone has the right to buy shares from us for $65. And that's at any time between now and the 24th, or 24 days from now, or the 25th of April. Did I say 160? Yes, I definitely did. Jay Richardson, thank you. Yeah, if you ever see me make a mistake like this, like I dropped the 1 here, let's get this. Doesn't change the structure of the trade at all. It certainly changes the implications of, the obligation and the right here. Yeah, but we have the right to buy the shares for 162.5, and an obligation now to maybe have to sell those same shares for 165. There's still a $2.50 distinction between the two. Still a $2.50 separation between the two. But I want to throw out a question to you. Do we want these contracts to be exercised and assigned? What is the preference of this trade? What is the best case outcome at expiration, or really any time before? The answer to that is yes, we want these contracts to be, we want to exercise our right to buy at 162.5. We want someone else to assign the right to buy shares from us for 165, because if we do the math with me, if we buy shares for 162.5 and we sell them for 165, isn't that a $2.50 profit? Yeah, it is. However, that would be a $2.50 profit, I like to say, if this were a free trade. This isn't a free trade. Okay, Eva, you're bringing in another variable here. If a trader, you say it depends on the dividend. Okay, well, we're not talking about trading the stock here, although some traders may have a motivation some way to do this. Typically in a vertical spread, that's not a big consideration, all right? But in any case, if this were a free trade to set up, that would just be a $2.50 profit if the intended outcome actually occurred. It's not a free trade. What is the net cost of this trade? The cost, or in other words, the theoretical max loss of this trade. If we're spending this much on the trade, we could lose what we spent. Well, if we spent $730 on the 162 contracts, 162.5, but we brought in $545, that leaves us with not quite $2 difference there. That's a $1.85 difference. Now, always double check my math for me, because I just did this, off the top of my head. Every once in a while I blow it. But in any case, it's costing us $1.85 to set up this trade. And if the trade works out as planned, we're going to turn that $1.85 into $2.50. Doesn't sound like a lot, but actually, as a percentage return, that's still a substantial sum. So what is the maximum theoretical gain? If we do turn this into a $2.50 value, but it costs us $1.85 to set the trade up, that leaves us with 65 cents that might be made. So what we're doing here is tying up $1.85 in pursuit of a $65 reward. That's about, what, a 35% return? That's a pretty strong potential return. And there's a strong probability that we're going to achieve that return. Now, what we're going to do is thoroughly break down this trade, and then we're going to change the elements just by changing the strike prices into a substantially different trade. My argument would be that there's an enormous difference between the two trades that we're going to be setting up. But in any case, before we proceed with that, I do want to hit the pause button for just a moment, because it's been pointed out to me that there is a survey in the chat window right now. So this is just for those that are watching live. But if you're here and you're live, go ahead and click on that survey link right now. That'll have it ready for you to fill out after the webcast is over, when you can give me some honest feedback. But I do want to let those that are new to these webcasts know the surveys that we ask that you fill out, very short, 2 multiple choice questions, and it could be done just there. It could be just click, click, scale of up to 10, basically. Just a click, click, and you could be done. Or there's also a comments box and a suggestion box. I just say that if you take the time to fill out my surveys, I promise you I'll take the time to read through that data. I read through the comments, and it helps. All right? So thank you. Yeah, Eva, exactly right. I read the surveys, and I like that feedback. Absolutely true. So let's get back to our little trade scenario here. We now see how much we can lose on this trade, how much we've invested in this trade. Here's how much we can make. Yes, with the trade as currently structured, there is more that could potentially be lost than could potentially be made, and that has to do with the probabilities of both of those outcomes. So let's look at the probabilities. What are the chances? If we're risking $1.85 and we don't want to lose $1.85, what are the chances that we might actually do that? Well, one of the columns here on Thinkorswim is delta. Now, if you're not seeing delta, you can choose it from this drop down right here. You can just choose the Greeks right there, delta, gamma, theta, vega. But delta has a couple of different purposes for traders, as we've discussed in our series of lessons. Number one is it can tell us the degree of leverage on our trade, how much an option might make or lose on a $1 move in the underlying. It can also tell us the probabilities of something happening at expiration, and specifically, delta is calculated to tell us the approximate likelihood that a contract will expire in the money. Now, there's an interesting thing about in the money options. They're all assigned, all exercised at expiration automatically, unless the owner of that contract leaves explicit instructions not to do that, which is relatively uncommon. So let's look at our 165 call, and it has a delta of 64. There is a 64% probability that that contract will be in the money, which will create our maximum gain scenario. Yep. Yeah, BLB111 says, yeah, he does read them. Yep, exactly. Yeah, that there is a 64% chance that we're going to hit theoretical maximum gain. Now, we can actually just look at the chart and sort of guesstimate that. Look at where the stock is right now. Look at where 165 is. The stock is already above that 165 strike. That contract is already in the money. And as long as the stock doesn't fall down too far, then it will still be in the money at expiration. Especially, it can fall down below that strike before expiration, but as long as it recovers before then, pops back up above, that contract is in the money, and with rare exceptions, it'll be exercised. So what happens if the stock is above 165? Let's just say the stock stays right where it is. Maybe it floats down a little bit. Maybe it goes up a bit. Doesn't matter. If we're above 165 and someone has the right to buy shares from us for 165 or at a lower price than market price, are they going to do it? Yep, they're going to do it with rare exceptions. Matter of fact, at expiration, they all do it with very rare exceptions. So the shares are purchased from us for 165, but we have the right to buy shares for 162.5. So we buy the shares at 162.5, we sell those at 165, and there's our maximum gain achieved. So what I like to do, just for a visual reference point for my attendees, is I'll just draw in a box here. That'll change for our second trade scenario. But up here is where we'd like to be. Well, what are the probabilities that we lose the 185? Because we got 3 times as much to lose as we stand to gain. There's also a much lower probability of that happening. Let's go back to our trade tab, and look at that 162.5. There's actually a 73% chance that this one expires in the money, or let's reverse the numbers there. There is a 27% chance that that contract is out of the money. So there's a 27% chance that we wind up somewhere down here at expiration. And just eyeballing that again, you could probably estimate that, or something relatively close. Because look at where the stock is right now. If it goes up, we're not wanting to get up down here. If it comes down, but it doesn't come down too far, we're still not down here. If we are down below 162.5 at expiration, that's where we are in the real danger zone of maximum theoretical loss. And here's why. If the stock's down here at, let's say, 160, and someone has the right to buy shares from us for 162.5, do they have any real motivation to do that? Probably not. At expiration, the contract just expires worthless with rare exceptions again. So, actually, sorry, we have the right to buy at 162.5. In any case, we don't exercise our contract. We don't buy the shares at 162.5. and the trader who has the right to buy those same shares from us for 165, they don't either. So we lose our investment of 730. We get to retain their payment of 545, but the net between those two is we lost our $1.85 if we wind up down here. So that's a lower probability scenario, only 27% chance that that happens, but it can be painful if it does. So if the stock starts to misbehave, maybe the trader wants to have a plan. I'm going to get out before that occurs, maybe with loss, but not with maximum loss. All right, now there's something else that may happen. And that is we might wind up somewhere in between max gain and max loss. Maybe we have some loss, but not maximum loss. Maybe we have some gain, but not maximum gain. There's actually a break-even point in between those two levels. Let me show you how to calculate a break-even point because it's going to be important as we compare our other strike selections here. So let's calculate break-even. Here's the way I think about break-even. What the trader needs to know is where the stock needs to be for their maximum gain. This is a bullish vertical spread. So we need to be above 165 right up here in order to be in position for our maximum gain. Well, if I reverse my logic here, that means that if I'm not above 165, I must not be making my maximum gain. And if I fall below 165, if the maximum gain is 65 cents, and I fall 65 cents short of my goal, guess what? There's our break-even point. So our break-even point is actually going to be 164.35 for this trade. So let's draw in a line there, 164.35. I'm going to get it as closely as I can. That's okay. Right there. There's our break-even. All right. So if we're above that, we have some gain at expiration, just not maximum gain. What has really occurred, though, is let's say we're at 164. How about we put that in here, by the way, so we can track it specifically, 164.35. Let's suppose that's exactly where the stock is at expiration. All right. Well, we have the right to buy shares for 162.5. They're worth 164.35. Awesome. That's giving us a discount of $1.85 from that price. So do we exercise that right? Yes. As a matter of fact, it's automatically done on our behalf at expiration if we're still in these contracts. So we wind up buying the shares at 162.5. They're worth 164.35. Great. We have now an unrealized gain in that stock ownership. And you might think, well, cool, but the other person's going to buy the shares from us, aren't they? No, they're not. Probably not, because they'd be overpaying. They have the right to buy the shares for 165. They ain't worth that much. They're worth 164.35. So that trader walks away. So now we have an unrealized gain on stocks we now own, on shares we now own, set against the and it's, by the way, it's $1.85 unrealized gain, but it costs us $1.85 to set this trade up. That's a wash. So there's our break-even point on our trade. So these are the elements of the trade that the trader may want to have in mind. And for some, they'll look at this and say to themselves, hey, so I could make 65 cents. Let's be specific about here. I can make $65 on a 185 investment. That's a 35% return on risk, or if you want to call it ROI, it's basically the same thing with vertical spreads, 35%. And there is a high probability of success on this trade. So one trader may look at that trade scenario and say, that looks pretty nice to me. And they're going to go right ahead with that trade based on their technical assumptions for CVX. And they're now in a trade with 35% reward potential, with a 64% probability of maximum success, and off they go. Now, trader B may choose an entirely different set of strikes. Let me copy this, and we are going to change this in what might seem to be a subtle way, but to me, the word that I'm going to use is enormous or dramatic or huge. There are big differences. Trade B, we're going to go out of the money. We're still going to stick with the same stock, the same expiration to keep those variables constant. But instead of doing the 162.5, the 165, how about we crank this up? Let's do like a 170 and a I'm going to have to see what these are trading for, but a 172.5 call. Now, we don't know how much these are going to cost us. So let's take that out. We don't know how much our maximum gain is going to be, but I'm going to leave the dollar sign in there. These are just going to be points to keep us on track here with our comparison. We don't know how much the theoretical max gain is going to be, although I could have left the 250 in there. But we do need to understand these variables and how they change just with different strike prices. Okay? William says, would you sell the vertical instead of getting the stock transaction? Now, that's a good question, William. Yeah, so if we're in between these strikes, our short contract could be assigned at any time, but remember, assignment is actually what the trader wants in most scenarios here, because if they're assigned and the other party decides, hey, I'm going to buy those shares from Cameron for 165, that means, hey, I could immediately exercise my right to buy those shares for 162.5, and bingo, we have our maximum theoretical gain. So assignment can be kind of spooky, but actually that's the desired outcome in most scenarios in this sort of a vertical spread. Now, if we're in between the strikes, that's where we are exposed to our contract gets exercised. It wouldn't happen before expiration, but if we fall asleep at the wheel, let it get to expiration, we wind up buying those shares, and there's nobody on the other side to sell them to. That person just let their contract expire worthless, probably. In any case, yeah, we wind up buying the shares. So if we don't want share ownership and we're in between the two strikes as we approach expiration, maybe the trader wants to consider doing what Williams proposed and just exit that vertical spread for whatever they can get for it at that point. It's probably going to be less than maximum gain. It's probably going to be better than maximum loss if we do that. All right, so good question. Doug says this is sort of cash intensive. Well, yeah, this initial trade scenario, to do that vertical spread, how much would it cost? How much cash would it tie up? $185 per contract. Yep. There we go. But let's look at trade B. Same technical setup. I'm going to leave these other lines on here for just a moment, although they're going to change a little bit. Not just a little bit, but a lot. Oh, you meant, yeah. Cash intensive, Doug, if we get to expiration. Exactly right. Yep. And William, yep, I figured you meant if they're in between. Exactly. But it opened up that window of opportunity for me to sort of discuss all the different outcomes. So let's go structure a very different trade scenario. All we've done here is chosen different strikes. Now I'm using these as just examples for comparison, but we really could have chosen any different, any individual groupings of vertical spreads to do that same comparison. But let's see, let's go for that 170 and the 172.5. It looks like, how much would it cost us to buy that 170? It's not going to cost us nearly as much because we're offering to pay more for the shares. So 248 to 255. Let me make this kind of round numbers. Let's say that one's 255. Okay, so let's say we buy that for 255. And then we sell the 172.5, and that looks like it might bring in 155 to 160 or 153 to 160. Let's call it 155. What do you notice right away? This is a less expensive trade scenario. We are spending 255. We're receiving 155. So how much is the cost of the trade now? It's gone down from $1.85 to just $1. However, we still have the same scenario where we have the right to buy shares and someone else has the right to buy those same shares for $2.50 more. So instead of trying to turn $1.85 into $2.50, we're trying to turn $1 into $2.50. So here's that maximum gain. It's going to still be $2.50 minus just $1 to set this trade up. Wow. That Actually, we're talking about 80 cents here or there. Doesn't sound like a lot. Cameron, why did you say, what was the term I used? Enormous difference? Yeah. Patrick says, are we only paying for one share price for these trades, or are we having to pay for each one? So Patrick, yeah, for these contracts, we take whatever this cost is, multiply it by 100, because each one of these contracts, these are what we call standard contracts. It represents the potential exchange of 100 shares, and this is quoted on a per share basis. Great question. All right. But yeah, here we're spending $1 to set up a trade that, if it goes as planned, we're going to buy shares for 170 and sell them for 172.5. That'd be a $2.50 profit, except it costs $1 to set this up. That leaves $1.50. Let's do the ROR, ROI on this. If we have $1 at risk and $1.50 to be made, that's not 35% return on risk, return on investment. That is 150%. Now, can we squeeze the definition of the word enormous into that? There's a huge difference between those two reward risk scenarios, isn't there? 35% versus more than doubling our money. So yeah, that is a huge difference just by choosing different strikes. So right now, the trader might be leaning heavily toward, well, geez, I can make way more money on a smaller investment with this one. What's wrong with it? That has to do with probabilities. Where does this trade need to be in order for this $2.50 to be realized? Here's how that trade scenario has changed. I'm actually going to have to pull my chart scale down. Let's activate this drawing, and I'm going to pull it up here. We don't need to be, let's see, I'm going to have to eyeball this. Where's 172.5? It's got to go higher. Oh, I got to go above 170, obviously. Let's go up here to 172.5. Nope, not even there yet. It's pretty close. It's pretty close. There we go. That's our maximum gain territory now. Notice we went from already there. Kevin says, how do you calculate ROR, ROI? Here we go, Kevin. It's going to be this. It's going to be, in this case, 65 cents divided by $1.85. And in this case, it's going to be $1.50 divided by $1. Because there is 65 cents reward, $1.85 risk, 35%. $1.50 reward, $1 risk, 150%. I know, Eva, they're similar terms, but whatever. We'll be redundant. That's okay. The huge versus enormous is what she's talking about. But in any case, yeah, we can make a lot of money, but this is a lower probability scenario. I think you can just see that visually. Plus, what has happened to the probability of risk? Well, in this case, to be at maximum gain, we'd need to be above 172.5. At expiration, to be at maximum loss, we'd only need to be below 170, and look at where we are right now. So this has some work to do. Let's pop this up to 170. At least I have a line there that helped me eyeball that just quickly. This is a very different trade scenario. So we can even, let's just right click on this and remove our trend line. Let's remove that one, and let's remove that one because those have changed. Cancel that. Remove that trend line. Here are now our two spreads, our two contracts. 172.5. 170 is right there. Where's the break even on this trade? I taught you how to do this calculation. If we need to be up above 172.5 to be in our maximum theoretical gain position, that makes us $1.50. Well, if we're short of 172.5 as we get toward that expiration, we must be surrendering some of that gain of that 150. So yeah, we're going to take 172.5, and $1.50 below that at 171 is going to be our break even. right there. Yeah, that's a very different trade scenario. Shantha says, when are earnings? So it's right here, Shantha, that they're on May 2nd. So it's after this trade is well done. And it's not the 25th, but it's 5/2. All right. So this is looking like lower probability, but boy, some traders may look at this and say, that's just what I want. I'm okay with taking this smaller risk with that higher reward potential, because maybe our trader is just convinced that we've broken up through this resistance. Look what CVX did before that. It raced up through, broke through. If it goes racing on again, could it very well get up to 172.5? Yeah, it could. In which case, there is a big reward waiting. However, it's just not very likely to actually do that. Let's go back to our delta and examine the probabilities of this trade. Okay, first of all, let's look at the delta for 172.5. There is only a 29% chance that we're actually above that level. If we're above 172.5, that's where we're in position to make our maximum gain. Low probability of success, but big reward potential if we are successful. Instead, there's actually a higher probability of this happening. There's only a 40% chance that even the 170 is in the money at expiration. If it's out of the money, both the contracts just expire worthless and we lose our dollar. And there is a 60% chance of that happening. So, I might as well put in that break even as well. There we go. But these are the numbers for this different trade setup. Now, let me ask you, as you look at these two, which one is the right one for our trader? That's kind of a loaded question, isn't it? Because there is no right choice here, because, it just depends on what the stock does from here. If the stock blasts off, Trader B here is going to say, Trader A, you were a sucker. There was 150% profit potential right there on the table, but you got so conservative, you robbed yourself of that potential. In a scenario where the stock does blast off, Trader B makes way more money. But what if it doesn't blast off? In that case, let's just say the stock just sort of wanders around, goes up a little bit, doesn't even get up to 170, but it also doesn't fall too far either. If it's still above 165 to any extent, which doesn't require a lot of the stock, this trader makes their full return. This trader loses the full amount. Yeah, Eva says, Cam, it depends. It absolutely does depend on the trader. Some are going to be more confident. They might say, hey, I'm going for a trade B because there's lots of reward and I recognize there's lower probability, but that's the scenario that makes sense to me. Another trader might say, well, I feel pretty good about my technical analysis, but I'm willing to surrender the upside potential to a large extent in exchange for having a high probability. I got 64% probability if I just set it up with the higher probability trade. So yeah, bottom line is there is a huge difference between strike selections with vertical spreads. And we could make this probability go up even higher if the trader has a preference for an even higher probability, or we could pursue even higher reward. It's just that there is a teeter-totter relationship for the traders when they're setting these up. The higher the probability of success on a trade, the smaller the reward for being successful. The lower the probability of success on a trade, the higher the reward potential for being successful. That's the trade-off. So it really does come down to the trader to choose the strike prices that suit their outlook and their personality, the risk tolerances of their portfolio, if they're using these sorts of trades at all. But for this example, I think we're going to go ahead with the initial trade, 162.5, 165. Let's place that trade. So I'm going to go up here to where it says spread single. Let's change that to vertical. And that pairs up 162.5 with 165. And then we can just click on the ask price to create that buy order. This is going to be for one contract. And it looks like, how much does it cost? Oh, it hasn't really changed much at all. $1.85 was what we were thinking, let's go ahead and say we're willing to spend up to $1.85 to enter into this trade. Now, there's a possibility the order doesn't fill at all, but I'm going to enter our order at 185. And then the trader can just do the math here. Okay, if there's $185 cost to put this trade on, and let's say that we wanted to risk up to maybe a couple $1,000, maybe we could do 10 contracts. Just be aware that if we are doing these 10 contracts and we're in between our strikes, if our long call is allowed to be exercised, we'd be buying 1,000 shares. Got to be aware of that. So we need to keep an eye on this as we move toward expiration, especially if it's in between the strikes as we get toward that expiration. But let's click confirm and send. Going to buy 10 of these verticals, the 162.5, 165. That gives us $650 of profit potential on 10 contracts, $1,850 of loss potential on those contracts. And there is a commission here to be paid. Multiple contracts on multiple strikes, $10 total in this example scenario. Just please note that we've selected a weekly option series. A little reminder here that we're not trading the traditional third Friday expiration options. So those are called non-standard expiration dates. Don't be too spooked by the word non-standard. It just means it's not the third Friday of the month, which was the standard for a long time. All right, and we're going to send that order off, and we'll see if it fills. But in any case, guys, we have accomplished what I set out to do today. I wanted to talk through what I would call the not so subtle art of choosing strikes when trading options. It's not subtle because it makes huge changes in the structure of the trade and the reward, the risk, the probabilities, the break-even points, all of that. So I hope you've enjoyed that discussion. Oh, we just filled. Okay, look at that. Bought it right at 185, the whole thing just as we planned. But guys, time for me to let you go enjoy the rest of your day. Go watch the rest of our webcasts if they have an interest to you. But just remember that if you haven't subscribed to our Trader Talks channel yet on YouTube, you can go right down below the video stream right now, click on that subscribe button if you haven't done it already. Clicking on it when you have done it unsubscribes you, which is not great. In any case, but YouTube is where we house the previous webcasts that we've done. So just remember that you can go to YouTube, you can look for our channel. It's called Trader Talks Schwab Coaching Webcasts, and you can find the playlist right there. You can join the live streams right here. And make sure that you're also following Kevin and me and your other favorite instructors on X. If you have an account with X, give us a follow. You can find Kevin there at Kevin Horner CS. You can find me on X at Cameron May CS. So there's my handle. Make a good note of it, because with social media, you've got to be precise to make sure that you're following the right person. But yeah, at Cameron May CS. And this is where I'll post thoughts on what's happening with the markets. I'll conduct polls. Today, it was just this April Fool's joke that the weather played on us here in Utah. We've had great, beautiful weather for the last few weeks, and then got snowed on today. That's the way it goes. Any case, thank you to everybody that's already clicked the thumbs up or the like button on the webcast. I can see out of the 128 people watching, 61 have already clicked the like button. That is fabulous. Thank you for doing that. When you enjoy a webcast, make sure you click that thumbs up, because it's like giving applause to your presenter. It also gives my webcast a boost in the YouTube algorithm and allows more people to find these webcasts and learn about important things like strike selection when setting up an options trade. So thanks, everybody. Final reminder, fill out that survey if you would. That'll be great. It's a very short survey. I'll read through your comments and the data that's provided in your feedback, so it's definitely helpful. Everybody, I will see you next Tuesday for another discussion of getting started with options, or I have other webcasts every single day of the week. So you can find me on the calendar. I'll see you in those other webcasts. I'll also look for you on X, but whenever I see you again, until that moment arrives, I want to wish you the very best of luck. Happy trading. Bye-bye.